Preparing the statement of cash flows is arguably one of the most daunting experiences faced by students of financial accounting. Hopefully in this discussion, I'll have some tips, tricks, and techniques that will help simplify the process for you. Whether you're preparing the indirect statement, like we're going to look at in a few minutes here, or the direct version of the statement of cash flows that we will explore in a different discussion. Now, as a starting point, what I did is I just wanted to create a very simple example, a simple illustration of some transactions incurred by a business, relatively few transactions, of course, and that will give us kind of a baseline for what the cash flows look like. Now, the reality is this. If you're preparing the statement of cash flows for a real business, you're not going to go through each individual transaction, classify them as operating, investing, or financing, and then summarize the cash flows. You certainly could do that, but that would be an incredibly complicated and time-consuming task if you're doing that for any business of substance, any size business. So the reality is what we do is we take year-end financial statements, a summary balance sheet for this year, a summary balance sheet for the previous year, a summary income statement, and then we look at some relationships that exist to back into these cash flows. But I wanted to start out with this list so that we can kind of prove it to you. Now, take a look at what I have here. We have just a handful of transactions. Issue common stock to owners. That's a financing activity. The company receives cash coming in, and so that's a positive financing cash flow. The same is true for this loan from the bank. We borrow some money. That's a financing cash flow, and you can see both of those coming in. Then we purchase some equipment. To the extent that we paid for that equipment using cash, that will be an investing cash flow. Later on, we'll talk about some nuances where perhaps a company does not use cash to purchase fixed assets. Maybe they borrow some money. But in this case, what we can see is the company capitalized itself with $150,000 from owners and from the bank, and it's using some of that cash to purchase equipment. Then I have a transaction down here, and it says receive inventory. And you notice I've got an operating, because that would be an operating type of activity, but it's not an operating cash flow. The reality, and you're not seeing this exactly on the screen, but I'm about to tell you, is that the company was extended credit from its vendor. So in other words, just the receipt of inventory did not affect the company's checkbook. What happened was the inventory account increased, in this case by $30,000, and accounts payable, a current liability, increased. You see, this one transaction did nothing to affect the company's cash position. Then we make some cash sales to customers. That's an operating activity. And if the customers are paying us cash, we're receiving that cash. That is a cash inflow. Contrast that with this next transaction, making credit sales to customers. Now, kind of like with the inventory, this is an operating activity, but it did not yet affect cash. What you're seeing here is that the company's receivables are going to go up, in this case by $1,000, but there's nothing happening with cash. The revenue increases as well, nothing in the checkbook. Then the account payable we had up here that was $30,000, we're going to pay half of that. So we pay the vendor. So what you're seeing is this. When we received the inventory, that did not affect our cash flow because the company's checking balance did not go up or down. But then when we actually make a payment on that accounts payable, that's when the cash flow is being affected. So paying accounts payable certainly is an operating cash flow, and it's a reduction of cash. As we pay for other expenses, I just kind of lump these together, various operating expenses and then interest expense. I know that a real business would have individual expense accounts, payroll expense, repairs and maintenance, property taxes, insurance, things like that. But to keep the example simple, I just said we're going to pay various operating expenses, and that uses cash. So does paying interest expense to the bank. Then we've got a couple of transactions down here that have zeros again. Right? Under accrual accounting, at the end of the period, we need to adjust our inventory. Inventory goes up or down. Cost of goods sold will go down or up, depending on where the inventory, what inventory is being affected. In this case, what we're seeing is the company actually reduced its inventory balance by $12,000. So in this case, inventory went down by $12,000, and the other part of that adjustment is that cost of goods sold and expense on the income statement increased by $12,000, and that affects the income statement, but it does nothing to affect the company's checkbook. Okay? Then we have depreciation expense. In this case, the company's depreciation expense is $800 for the period, just for this initial month. And that $800, we're going to see that in the income statement in just a moment, but that does nothing to affect the company's cash position. So that's not part of the cash flows. Our final transaction, one of the benefits of being a corporate shareholder is you may be eligible to receive dividends. And in this simplistic example, we did pay a $1,000 dividend to our owners. That goes over here in the financing section as cash leaving the organization. So what you see overall here, for this initial month of operations, this is a brand new company I've given you here. So every account started at 0 at the beginning of January. So at the end of January, we're seeing that the cash balance on the balance sheet should be $70,500 because it started as 0. And so that's one thing to look for in a minute as we continue our discussion. And when we ultimately complete the statement of cash flows, we should see that the operating section shows $1,500 coming into the organization because of its operations, $80,000 leaving the organization because of investing activities, and $149,000 net coming into the organization because of financing activities. So let's go and prepare the statement of cash flows and see if we can get the numbers to match what actually happened. As I suggested a moment ago, when you actually prepare a statement of cash flows for a company at the end of its period, you're probably not going to go through a list of all of the transactions that occurred for that period and put them into the buckets of operating, investing, and financing activities. That would just be far too time-consuming. So what we do instead is at the end of a period, we take the aggregated income statement and comparative balance sheets, and we use information from these to derive the operating, investing, and financing cash flows. Now, in a more complicated example, we would actually have side-by-side balance sheets. The current balance sheet and then the previous balance sheet. What I chose to do in this example to keep things simple is I made this a brand new entity. January of 2020 is this coffee house's first month of operations. So the reality is everything on this balance sheet for the prior period would have been 0. So everything you see here is an increase. That won't necessarily be the case if you were looking at other scenarios with an ongoing company, because the reality is over time, accounts receivable sometimes goes up, sometimes goes down. Accounts payable could be an increase, could be a decrease. So just keep that in mind, that as we go through our discussion, everything in this particular balance sheet is an increase just because it's a brand new entity, first month of operations. Now, as you take a look at, let's take the income statement here for the month of January. We have our sales revenue, but if you remember, when we were looking at the list of transactions a few minutes ago, some of those sales were non-cash. Remember the $1,000 of credit sales? Well, that didn't involve cash. So we're going to have to unravel that $1,000 that is in net income. It's causing net income to be bigger, but did not affect our company's checkbook. The same is true with this cost of goods sold. Remember just a moment ago, we had an adjusting entry that reduced our inventory balance and increased cost of goods sold. That's why cost of goods sold is listed as $12,000 on this accrual basis statement, but that did not all involve cash. In fact, what involved cash was, if you remember, the company purchased $30,000 worth of inventory and then later on paid for half of it. So some things that are affecting this accounts payable account may actually impact the cash balance, but aren't reflected over here. Then take this little animal right here, depreciation expense. That was one of the entries that was in the list we looked at. And if you remember, depreciation expense had a big goose egg 0 in the operating section. That's because depreciation expense does not affect our company's checking account. The journal entry to record depreciation expense is simply this right here. Depreciation expense, I'm going to abbreviate it. In this case, would go up by $800. That's why you're seeing this amount right here. Then this contra asset called accumulated depreciation also goes up by $800. Now, since it's a contra asset, this is a debit, this is a credit. When we credit a contra asset, it actually makes our net book value lower, and you're seeing that right over here. So that expense of $800 for depreciation did not touch the company's checkbook. We're going to have to unravel this when, in just a moment, we take accrual basis net income and convert it into operating cash flow. This skeleton right here will be our template for preparing the operating section of the statement of cash flows. By the time we're done in just a few minutes, we will have taken accrual basis net income, which as a reminder is $4,700, and we will have used these adjustments to convert $4,700 of accrual basis net income to hopefully this $1,500 that we have in our summary of operating cash flows. So let's do it. Okay? We start up here with our net income. So look at your income statement. Net income measured under the accrual basis for the period is $4,700. That's our starting point. That is the results of our operations. Our operations boil down to accrual basis income of $4,700 for the month. But the reality is, even though that's the income that we earned during the month of January, that's not equal to the change in cash for the month of January that's attributed to operating activities. So the first thing we have to do is we have to add back depreciation expense. That's really going to be, in most cases, your low-hanging fruit, is you want to take depreciation expense and add it back. Now, think about it this way. Do you remember that journal entry that we had on the screen just a moment ago where we recorded depreciation expense and then we recorded an increase to accumulated depreciation? Let's say we had forgotten to make that entry. If we forgot to make that entry, our net income would have been $5,500 and we would have no add back here, okay? Because you see, that depreciation expense did not affect cash flow. That $800 is an expense that is causing our net income to be lower, but is not causing our checkbook balance to be lower, okay? And hopefully that kind of explains why we need to add back depreciation expense. Now the reality is, depreciation expense is not the only potential add back. Any expense that did not require cash is a candidate for being added back. Amortization expense involving intangible assets, depletion expense for natural resources. If you sold some property, plant, and equipment and you recorded a loss, that's a potential add back. You could actually also be adding or subtracting a gain. If you had a gain from the sale of property, plant, and equipment, that's something that did not affect cash but would make your net income bigger. So if you have any gains that are non-cash, you would actually subtract those. So what you're doing in this section is you're initially taking non-cash expenses and maybe some non-cash income items, and you're either adding them back or subtracting them. In a moment now, what we're going to do is we're going to move on to looking at some of our current assets, and we're going to see what happened with them. In our little coffee house example, we now have a partially completed operating section. Net income from the income statement, add back the depreciation expense. Now we have to look at our changes in our current assets. And what you see over here, this is the ending balance sheet. And notice this, the date of the balance sheet is the end of this month, January 31 of 2020. The statement of cash flows is covering the period. So in other words, the entire period from January 1 through January 31 for the month of January. A lot of times you'll see that as the entire year. But in this case, I just kind of wanted to keep it simple. So remember, this is a brand new business. So everything you see here is an increase. If you take a look at accounts receivable is $1,000 at the end of January. It's because of that single sale that we made to a customer where we extended credit to them. And so it increased from the beginning of the month to the end of the month. If accounts receivable increases, the rule is going to be this. We're going to subtract that increase. All right? And this should make sense because think about that transaction. Let me put kind of the what's happening here. Accounts receivable increased by $1,000, and then sales revenue also increased by $1,000. That's the substance of that single transaction that caused this receivable to be on the balance sheet. So let's think about that. Increasing your revenues makes your net income go up by $1,000. However, it did not make your cash position go up. So what we're seeing here, since in the big picture, in aggregate, accounts receivable went from 0 to 1,000, that's a $1,000 increase, but that $1,000 increase did not make your cash position go up, even though it made net income go up. We need to subtract the effect of that increase. That is the best example I can give you for the reason that we subtract an increase in accounts receivable when preparing the indirect statement of cash flows. Okay? Then we have to look at other current assets. Now, my recommendation is this. Memorize or be able to reason through, understand why it is that we subtract an increase in accounts receivable. Because if you can commit that to memory, or if you can at least develop a technique for reasoning your way through the rule for accounts receivable, you now know what to do for any other current asset, because they're all going to have the same behavior. If any other current asset, such as inventory, increases, you're going to subtract that as well. Okay? Right? And if we had other assets on here, like prepaid expenses as just one other example, if that increases, subtract that too. So once you know what to do for accounts receivable, you can use that to develop a roadmap for any other current asset. Now the reality is this, if a current asset decreases, then you're actually going to add that back, okay? What I'd like to say about that is this. Let's pretend you had a situation where in the first year, you record this revenue and the accounts receivable goes up. Well, that did not affect cash flow. Let's say that in the second period, you didn't do anything except collect this receivable. So in that second period, your net income under the accrual basis would be 0. If you didn't generate any more revenues, if you had no other expenses. Yes, I know that's a fairy tale land where unicorns are flying around. But if that were the case, then your net income would be 0. But if your accounts receivable decreased, it must mean that you collected that receivable and converted it to cash. So that's another way of remembering what happens with accounts receivable. If accounts receivable decreases from one balance sheet to the next, you can conceive it this way, that the company has received that cash, and so that needs to get added to net income. Current assets, if they go up, subtract them. If they go down, add them back. We have the effects of current assets over here. Now we need to turn the corner and look at current liabilities. I've given you a partial balance sheet here, just the liabilities section. And again, it's a simplified example where everything's an increase. So at the beginning of January, our accounts payable balance would have been 0. At the end of January, it's $15,000. The rule with current liabilities is this. If a current liability increases, add it back to net income. So over in our example there, accounts payable is increasing from 0 to $15,000. So we're going to add that back when preparing the indirect operating section for the statement of cash flows. You can almost think about it this way. If your accounts payable balance is increasing, your vendors are effectively financing some of your operations, right? If accounts payable goes up, they're financing. You might remember in this particular instance, the company had purchased $30,000 worth of inventory on credit. So at one point during the month, accounts payable was $30,000. And then later in the month, they paid half of that bill. So the reality is they got $30,000 worth of inventory. They paid for half of it with cash, but this $15,000 that's still sitting there in accounts payable, the vendor extended credit to them. This was a source of cash for them. That's why we add back increases to accounts payable. Of course, if accounts payable decreases, then we're going to subtract that in our reconciliation here, because that means in the big picture you're actually paying back some of that liability. And last time I checked, most vendors like to receive cash in exchange for what is for them an account receivable. So we have the building blocks here. We're done. I would like to point out that the accounts payable would probably not be the only current liability that you would see in a more realistic scenario. You would see things like accrued expenses or various payables, maybe insurance expense payable or accrued interest, things like that. And those would all factor in. But just like I mentioned with current assets, if you know what to do for accounts receivable, you can apply those same rules to any other current asset. Same is true here. If you know what to do for accounts payable, then you know what to do for any other current liability that you will encounter. In fact, I would argue this. If you can reason through or memorize what to do for accounts receivable, you've got all the building blocks. Because once you know what to do for accounts receivable, do the same thing for any other current asset, and then do the opposite for any other current liability. You notice over here, when these two current assets increased, we subtracted them. But when this current liability increased, we added it. So the behavior in the indirect operating section for current liabilities is exactly the opposite of current assets. Now it's just a little bit of math. We take the $4,700 of net income, add back our depreciation expense of $800, subtract these two increases in current assets, add back this one increase in current liabilities, and we see that the operating cash flow, at least mathematically, is $1,500. As you can see, the cash provided by operating activities that we calculated essentially using a reconciliation of accrual income to cash flow nicely matches the operating cash flow that we summarized at the very beginning of our discussion. And you might be wondering, is this just busy work? I mean, why not just measure net income according to the cash basis? You'd have your $1,500 number, and then we wouldn't have to go through all of this. Well, the reality is this. Cash flow is the lifeblood of the organization. So we need some way to measure when cash is leaving the organization, when it's coming into the organization. That's so critical. Because without cash, you can't pay your operating expenses, you can't pay your employees. You get the point. But we also need this accrual basis net income measurement, because this places the revenues in the period where they're earned, and it places the expenses in the period when they're incurred. Even if we did not earn those revenues in terms of cash during that period, and even if we did not actually pay the expenses using cash in that period. It's so critical to be able to measure the results of our operations for a particular period, even when the checkbook wasn't affected. So we really need both of these numbers. We need the income statement to tell this story under the accrual method. But then at the end of the day, we really need to figure out what happened to cash in the organization so that we can make decisions about the company's liquidity. Before we wrap up our discussion of the operating section and move on to investing and financing, I just want to give you some basic ground rules. And this is really just a summary of what we did. Your starting point is always going to be net income or net loss from your income statement. And it could be either number. Hopefully it's a net income. We want profitable companies, but sometimes companies report an operating loss. And after that net income or net loss, you're going to add back any of these items over here if they exist. Add back depreciation expense, add back amortization expense. If you have losses from selling property and equipment or other assets, you would add those back. And then if there are other expenses that did not require cash, such as maybe depletion expense, you'd add that back too. Then you look if these exist. If there are any gains, you're going to subtract those. If there are any elements of income that did not require cash, you're going to subtract those as well. There's a pretty good chance that as you are preparing a statement of cash flows, you won't encounter all of these, but if you do, you know what to do to them. Then you go over here. If current assets go up, subtract them. If current assets go down, add them. Current liabilities go up, add them. Current liabilities go down, subtract them. This is a pretty good roadmap that will get you through the operating section of the indirect statement of cash flows when you see it on an exam or in real life. Now we move on to the investing section. Obviously, very simple example. This company started the month of January with nothing, with no equipment, no assets whatsoever. And at the end of the month, we have $80,000 worth of equipment. Assuming that we analyze this account, we have to make sure that that equipment was actually purchased with cash and wasn't financed with a note payable or something like that. But we do a little bit of analysis, drill down on that account, and we determine that yes, in fact, this equipment is on the balance sheet at an amount of $80,000 because the company actually paid cash. And we're going to include that as an investing outflow. Remember, the investing section could have cash outflows when a company purchases property, plant, equipment, or other long-term assets. It could also have investing inflows if the company is selling those types of assets. For example, let's say a company sells an old piece of equipment for $5,000. That would be cash inflows from the sale of equipment. Company in this case spends money to purchase equipment. That's a cash outflow. Other things that you could see in this scenario could be if a company makes loans to another entity or collects on those loans. Could also be if the company purchases investments, stocks, bonds, things like that, or sells those investments. So the investing section in this case is pretty simple, but I think you get the point that what you have to do is you actually have to ask yourself the question, is the company spending money or is the company receiving money for the types of transactions that would be included in the investing section? When we get to the financing section, comparative balance sheets are definitely the starting point, just like they were with investing activities. But also, just like investing activities, we need to ask ourselves, why is this balance at the level that it is? For example, we have common stock of $50,000. We know that the common stock account increased from $0 to $50,000 for this company. Why did it increase? Well, we do a little bit of investigation and we see that the company issued common stock and the shareholders contributed cash. Then we look at the long-term debt. There's this note payable over here. And we ask ourselves the question, why did that note payable increase from $0 to $100,000? And a little bit of investigation reveals, well, they borrowed money. So that's $100,000 coming into the company in the financing section. And then finally, paying dividends. Now that's not quite as evident, but if you remember, our net income was $4,700, right? And you can see down here, the retained earnings is $3,700, okay? So we look at the income statement, we see net income of $4,700. Retained earnings at the beginning of the year would have been 0, so we can kind of prove our retained earnings balance. Beginning retained earnings is 0. Add to that the net income that we earned for the month, and then subtract $1,000 of dividends. We just proved the ending retained earnings balance right here. And we also gave ourselves some information about the payment of dividends, because you see that analysis of retained earnings tells us that the company must have paid dividends of $1,000. And we could certainly confirm that. So what you're seeing here, net cash provided by financing activities is going to be $149,000. That's because we have $150,000 coming into the company from shareholders and lenders, but we did pay this little dividend of $1,000, so that nets out to $149,000 provided by financing activities. Now it's time to bring the three sections together. Notice that our operating activities, cash provided by operations of $1,500, and then over here we had our investing activities. That sucked $80,000 out of our organization. But then down here, financing activities, that contributed $149,000 to our organization. So we can take those amounts, right? We can take the $1,500 from operations, subtract the $80,000 used for investing activities, and then we can add the $149,000 coming in from financing activities. And we combine all those three amounts, and you'll see that the net increase in cash is indeed this $70,500, okay? So what you're basically doing, this number right here, this net increase in cash, is simply the combination, adding or subtracting, operating, investing, and financing subtotals. Now, of course, this certainly could be a net decrease in cash for a company. In this particular case, since it's a brand new company and your beginning cash balance is 0, it better be an increase, and it was, okay? So we started at 0. Our net increase in cash was $70,500, and our calculated ending cash balance down here is $70,500. In just a minute, we'll reveal the balance sheet, and we're going to make sure that that number matches the balance sheet. But before we do that, I just want to recap. We started our discussion with these transactions. Same list of transactions we had at the very beginning. And we had said, hey, if we kind of summarize every single transaction, we can see that operating activities had a cash flow of $1,500. Isn't it nice that that matches up right here? And the investing, $80,000 going out the door, matches up over here. And finally, that financing section right here. 149,000, excuse me. I was looking at just the low. 149,000 matches up with what we did over here. So because it's impractical to take every single transaction for a company for an entire year, for example, and classify it as operating, investing, and financing, unless we have systems in place to do that, which companies may or may not. So the reality is this. We just want to be able to take the year-end income statement and balance sheet and then convert it into the statement of cash flows for that particular period. Now, in this case, it's just 1 month. A lot of times it would be year-end. But you can see the kind of the beauty here. Take your income statement, take changes in your comparative balance sheets, take a little bit of additional information, and you can actually back into the company's change in cash. It's been a long journey, and the statement of cash flows truly can be quite an undertaking. But before we move on, I just want to point out one thing here. You know, if we had seen the beginning balance sheet with all those zeros, we would have seen a beginning cash balance of 0. And you actually can see that our calculated ending cash balance right there, the $70,500, matches our ending balance sheet cash. So the statement of cash flows for the month of January ultimately tells us that the ending cash balance on January 31 should be $70,500, and it proves the cash balance that is listed on the January balance sheet. You see, that's the beauty of the statement of cash flows, at least from an accounting bookkeeping perspective here. If I can take a number under the accrual basis, net income, and then I can look at all these adjustments, and I can prove this cash number, that leaves me with a nice warm fuzzy feeling in my stomach. I feel like I have a sense of accomplishment. Isn't it great when things balance out? Finally, let's talk about a few supplemental disclosures. With the indirect method, you're not specifically saying how much cash was paid for interest or for income taxes. So if you're using the indirect method, GAAP requires you to disclose these two amounts. Also, there is the possibility of non-cash investing and financing activities. The best way I can describe this is thinking about a vehicle loan. If you have decent credit, there's a pretty good chance that you could pause this video, go to the car dealership, and purchase a new vehicle without spending any money today. Now, of course, you'd be signing up for monthly payments, but that would effectively be a financing activity and an investing activity. You're investing in a car, and then you're financing it, but it never touched your checkbook, at least the initial transaction. So think about it this way. Let's say that you did go to a bank, okay, and let's just borrow $30,000 from the bank. So here's an activity that would cause your assets to increase, and it would cause your notes payable to go up, a liability, okay? That's a financing activity, borrowing money from the bank, okay? Then let's pretend that you turn around and you immediately use that cash to purchase a new vehicle or a piece of equipment, something like that. You're purchasing a long-term asset. Right? So what happens there is an investing activity where we're using cash to invest in equipment. Now, if you skip this step right here by purchasing a piece of equipment and financing it directly with a note payable, this is a non-cash activity. Equipment increases, and that's really an investing activity. And notes payable goes up, that's really a financing activity, but it's a non-cash investing and financing activity. So to the extent that you have transactions like this, those are also required to be disclosed. Because the reality is this is going to set us up for things that impact future cash flows. You're also going to have some disclosure in your financial statement footnotes about this note payable, kind of some general terms and repayment conditions and things like that. But when non-cash investing and financing activities exist, make sure we disclose those probably at the bottom of the indirect statement of cash flows.